Okay, guys. Fed is announcing so many stuff, and we gotta be careful, prepare, and not surprised because, as always, running with the numbers, we are here to tell you things about trend mindset is the new channel. We're just getting started with that, and new name, new opportunities, and things to grow, facts to take into consideration, the economy, the real estate, everything you need to know to not be screwed, not be a slave from from the big corporations and the Fed and Wall Street. So be freedom, be in freedom. And what happened with the Fed announcement? We have in the first place the yields, the benchmark, the 10-year Treasury note has a change, and the change was from 1.78% was the Treasury yield. What is the Treasury yield? What is that? How can we eat that? Well, the treasury yield is actually what the Fed or the U.S. government gives you, gives the the persons or the companies that buy the bonds, is the interest that they receive because of the debt of getting getting money from getting giving money to for bonds. Okay, when government gets money with those bonds, they give interest, and that's the yield. That's the Treasury yield. So the Treasury yield is going up. That that can be actually the door. It's been the door of the increasing in interest rates actually. What they said, that Mr. Jerome Powell, which is the chairman of the Fed, he just tell about increasing those rates up to March in this year. So that's that will be so many stuff going on in the economy because of that decision and that announcement. And what can we do with this announcement? How we are as a normal person affected, not as a big company, not as a big investor, but as a very very current normal person, standard person. And well, first we gotta know the current rate. Fed rate is 0.25%. So there is a tendency. We must know the tendency is that when interest rates are high, inflation tend to be lower. So it's an inverse relationship, and vice versa. If the rates are lower, okay, the inflation is higher. Okay, so that's important to know. Consumer price index. Okay, when we the CPI, famous CPI. So the Fed utilizes the CPI, Consumer Price Index, to establish the rates. Okay, so what is this affection when the Fed do those kind of announcements and decisions, when they actually make make those? First, the mortgages will be the cost of mortgage will increase actually. So in correlation, in going in the same place with the mortgages, and those this 10-year treasury, which is, as we said, the interest that offer the US government to the bond, the to for these bonds to get interest from home equity. Second thing that to have on our mind when we are talking about this interest increase. So home equity, the cost of when you are trying to get a HELOC that will be for your house. You get a HELOC, and when you have some changes on the interest rate, you will have you will be affecting the equity line of credit, because the the prices of the properties will actually be different, because the prices on properties will be in fact affected with those kind of movements from the Federal Reserve. So home equity will be different. Stock investors will have different prices. Right now we have movements in the stock market because of this FOMO, this fear of missing out, and everybody makes different decisions. Okay, and some are thinking about, well, myself, I just make a decision to get into buying the dip, but buying the dip in, until some point. Because why I tell you some point? That's that's because of, if we have a real dip, okay, we get a dip on some of those stocks that we're having performance. So if there's a dip, and then we have the money to invest more, that will be good, and we remain on the game with the remain money on the side. You have money on the side and you have money invested, so you will be in a little equilibrium on what you have, and what's your availability for new investments when the market dips even more. So that's something to take into consideration. The invest in the stock market will be affected with this rate increases, will be, and it's been, as we saw on these last days. So the U.S. federal government will be the debtors on the U.S. government will be different. The movements on that, the borrowers. So because the U.S. government is the biggest borrower of money, because, well, billions of dollars, 30 trillion, uh, nearly is the debt on the U.S. government. And when you when the government increase rates, it's affecting the this this capacity to get the loans to be as the borrower as it is the government, the U.S. government. So savings account and CDs and those those great certificates of deposit that have the banks. So when interest rate, what happens when these interest rates are going up? Well, the people, it's motivated to save more, quotes, okay, because we know that whatever interest, it's very low, and interest never cover inflation. We must be clear on that. So savings account and CDs will be affected, yes, and the people will tend to save more, maybe, quotation on that. Credit cards, in fact, when you have credit card debt and is the credit card, remember, those rates are variable and it will be affected with interest rates higher. With higher interest rates will be affected your credit card debt. So take a look, do your research. This is not financial advice. As always, smash the like button for the YouTube algorithm, and well, until the next video, bye bye.